Hi, and welcome to Accounting with Professor Lamptey. In the last lesson, we learned that debit means left, credit means right, and double entry accounting keeps everything in balance. Today, we are taking the next step. We are going to learn how to record actual business transactions using journal entries. This is where accounting starts to feel real, because once you understand journal entries, you are no longer just memorizing rules. You are learning how business events enter the accounting system. By the end of this lesson, you should understand what a journal entry is, why every journal entry needs debits and credits, how to decide which account to debit and which account to credit, and how to record common transactions step by step. Let's begin. A journal entry is the formal accounting record of a business transaction. When something happens in a business, accounting asks 4 questions. What accounts are affected? Did those accounts increase or decrease? Should we debit or credit each account? And finally, do total debits equal total credits? That is the heart of journal entries. Think of a journal entry as the first official written record of a transaction in the accounting system. Before a transaction appears in the financial statements, it must first be recorded. That first recording happens in the journal. That is why the journal is often called the Book of Original Entry. In simple terms, a journal entry is where the accounting story begins. Now let's connect this to what we already know. The accounting equation gives us the logic. Assets equals liabilities plus equity. Debits and credits give us the language. Debit means left, credit means right. Double entry gives us the rule. Total debits must equal total credits. And journal entries give us the actual record. So think of it this way. The accounting equation gives us the logic. Debits and credits give us the language. Double entry gives us the rule. Journal entries give us the record. Now let's look at the basic format of a journal entry. A simple journal entry has at least 2 lines. One account is debited, another account is credited. The debit is usually written first. The credit is written second and often indented slightly. For example, debit cash, $10,000. Credit owner's capital, $10,000. This means cash increased and owner's capital increased. But remember, this is not just decoration. Accounting is not trying to make the entry look pretty for no reason. The format tells the accounting system what happened. The debit records one side of the transaction, the credit records the other side, and the total debits must equal the total credits. If they do not, accounting will not be happy with you. And trust me, accounting has a very good memory. Now before we work examples, let's bring back the memory trick from the last lesson. Dealer D, E, A increase with debits. That means dividends or withdrawals, expenses, and assets increase with debits. L, E, R increase with credits. That means liabilities, equity, and revenue increase with credits. So when you are preparing a journal entry, do not guess. Use this 4-step method. Step 1, identify the accounts affected. Step 2, classify each account. Is it an asset, liability, equity, revenue, expense, or withdrawal? Step 3, determine whether each account increases or decreases. Step 4, apply the debit and credit rule. This 4-step method will save you from most journal entry mistakes. Now let's apply it using Amma's bakery. Amma starts her bakery by investing $10,000 cash into the business. The accounts affected are cash and owner's capital. Cash is an asset. Owner's capital is equity. Cash increases because the business received money. Owner's capital increases because the owner invested money into the business. Assets increase with debits, so we debit cash. Equity increases with credits, so we credit owner's capital. The journal entry is debit cash, $10,000. Credit owner's capital, $10,000. Now check it. Total debits, $10,000. Total credits, $10,000. The entry balances. That is double entry accounting in action. Now Amma buys bakery equipment for $4,000 cash. The accounts affected are equipment and cash. Equipment is an asset. Cash is also an asset. Equipment increases because the business now owns equipment. Cash decreases because the business paid cash. Assets increase with debits, so we debit equipment. Assets decrease with credits, so we credit cash. The journal entry is debit equipment, $4,000. Credit cash, $4,000. Notice something important. Both accounts are assets, so this transaction does not increase total assets overall. It simply changes the form of the assets. In everyday language, Amma exchanged cash for equipment. In accounting language, one asset increased and another asset decreased. Accounting says the same thing, just wearing a suit. Amma buys supplies for $800 cash. The accounts affected are supplies and cash. Supplies is an asset. Cash is also an asset. Supplies increase because the bakery now has more supplies. Cash decreases because the bakery paid cash. So we debit supplies and credit cash. The journal entry is debit supplies $800, credit cash $800. Again, total debits equal total credits. Now here is a small warning. Do not confuse supplies with supplies expense. If the business buys supplies and still has them available for future use, we usually record an asset called supplies. Later, when those supplies are used, we will record supplies expense. For now, remember this. Buying supplies creates an asset. Using supplies creates an expense. That distinction will become very important when we study adjusting entries. Now suppose Amma borrows $5,000 from the bank. The accounts affected are cash and bank loan payable. Cash is an asset. Bank loan payable is a liability. Cash increases because the bank deposited money into the business account. Bank loan payable increases because the business now owes money to the bank. Assets increase with debits, so we debit cash. Liabilities increase with credits, so we credit bank loan payable. The journal entry is debit cash, $5,000. Credit bank loan payable, $5,000. This entry tells the full story. The business has more cash, but it also has a new obligation. If someone only looks at the cash balance, they may think the business is stronger. But accounting says, hold on, where did that cash come from? If it came from a loan, then cash increased, but debt also increased. That is why journal entries matter. They do not just show what changed, they show why it changed. Amma sells bread and cakes for $2,000 cash. The accounts affected are cash and sales revenue. Cash is an asset. Sales revenue is a revenue account. Cash increases because the business received money. Sales revenue increases because the business earned income. Assets increase with debits, so we debit cash. Revenue increases with credits, so we credit sales revenue. The journal entry is debit cash, $2,000. Credit sales revenue, $2,000. Revenue increases equity. So even though we are not directly crediting owner's capital, revenue still increases the owner's claim on the business. That is why revenue has a normal credit balance. Revenue increases equity, and equity increases with credits. Amma pays $500 cash for rent. The accounts affected are rent expense and cash. Rent expense is an expense. Cash is an asset. Rent expense increases because the business incurred rent cost. Cash decreases because the business paid cash. Expenses increase with debits, so we debit rent expense. Assets decrease with credits, so we credit cash. The journal entry is debit rent expense, $500. Credit cash, $500. Expenses reduce equity. That is why expenses increase on the debit side. So when you see an expense being debited, do not panic. The expense is not doing anything strange. It is exactly where it belongs. Now let's look at a transaction that confuses many beginners. Amma provides catering services to a customer and earns $1,500 on account. On account means the customer has not paid cash yet, but Amma has already earned the revenue. The accounts affected are accounts receivable and service revenue. Accounts receivable is an asset. Service revenue is a revenue account. Accounts receivable increases because the customer now owes the business. Service revenue increases because the business earned revenue. Assets increase with debits, so we debit accounts receivable. Revenue increases with credits, so we credit service revenue. The journal entry is debit accounts receivable, $1,500. Credit service revenue, $1,500. This is where some students say, "Professor, where is the cash?" Good question. The cash is still on the way. Accounting records the revenue because the work has been done and the customer now owes the business. That is why we use accounts receivable. Accounting is not only about cash movement. Accounting records the financial effect of the transaction. Now suppose the customer later pays the $1,500 owed to Amma. The accounts affected are cash and accounts receivable. Cash is an asset. Accounts receivable is also an asset. Cash increases because the business received money. Accounts receivable decreases because the customer no longer owes the business. So we debit cash and credit accounts receivable. The journal entry is debit cash, $1,500, credit accounts receivable, $1,500. Now here's the key point. We do not record revenue again. Why? Because the revenue was already recorded when it was earned. Now we are only collecting cash from a customer who previously owed the business. If we recorded revenue again, we would count the same sale twice. And in accounting, double entry is good. But double counting revenue is not. That is not confidence. That is an error. Amma takes $300 cash from the business for personal use. The accounts affected are owner withdrawals and cash. Owner withdrawals is an equity-related account. Cash is an asset. Owner withdrawals increases because the owner took money out of the business. Cash decreases because the business paid cash to the owner. Withdrawals increase with debits because withdrawals reduce equity. Cash decreases with credits. The journal entry is debit owner withdrawals, $300. Credit cash, $300. Now let me make this clear. Withdrawals are not expenses. Rent is an expense. Wages are expenses. Utilities are expenses. But when the owner takes money out of the business for personal use, that is not an operating cost of the business. That is a withdrawal of owner's equity. For a corporation, this idea is similar to dividends. Dividends reduce equity, but dividends are not expenses. So please do not invite withdrawals to the expense party. They do not belong there. After working through these examples, you may be asking, "Professor, how do I know whether to debit or credit without getting lost?" Here is the answer. Use the 4-step method every time. Do not guess. Do not start with debit or credit. Start with the accounts. Ask yourself, what accounts are affected? Then ask, what type of accounts are they? Then ask, did each account increase or decrease? Only after that should you decide, debit or credit. This is the mistake many students make. They ask, is it a debit or a credit? But that is like trying to answer a question before reading the problem. The better question is, what type of account is this? And is it increasing or decreasing? Once you answer that, the debit or credit becomes much easier. Now let's talk about common journal entry mistakes. The first mistake is recording only one side of the transaction. For example, a student may say, cash increased by $2,000. That may be true, but it is incomplete. Accounting asks, why did cash increase? If cash increased because of revenue, then we also need to credit revenue. If cash increased because of a loan, then we also need to credit a liability. If cash increased because of owner investment, then we also need to credit owner's capital. Every transaction has at least two effects. That is double entry. The second mistake is confusing revenue with cash. Cash and revenue are not the same. A business can earn revenue before receiving cash. That creates accounts receivable. A business can also receive cash that is not revenue. For example, borrowing money from a bank increases cash, but it does not create revenue. It creates a liability. So do not ask only, did cash come in? Ask, why did cash come in? The third mistake is confusing expenses with withdrawals. Expenses are costs incurred to operate the business. Withdrawals are amounts taken out by the owner for personal use. Expenses reduce profit. Withdrawals reduce owner's equity. They are not the same. The fourth mistake is forgetting that total debits must equal total credits. Before you move on from any journal entry, always check, do total debits equal total credits? If they do not, something is wrong. Accounting is like a balance scale. It may forgive you later, but it will not balance until you fix it. Let's summarize what we learned. A journal entry is the formal accounting record of a business transaction. Every journal entry must follow double entry accounting. That means every transaction affects at least two accounts. Every journal entry has at least one debit and at least one credit. And total debits must always equal total credits. To prepare a journal entry, use the four-step method. Identify the accounts affected. Classify each account. Determine whether each account increases or decreases. Apply the debit and credit rule. And remember the key rule from the last lesson. Dealer. Dividends, expenses, and assets increase with debits. Liabilities, equity, and revenue increase with credits. If you can identify the accounts, classify them, and determine whether they increase or decrease, you can prepare the journal entry. That is the skill we are building. Thank you for watching Accounting with Professor Lamptey. If this lesson helped you understand journal entries more clearly, please like this video, subscribe to the channel, and turn on notifications so you do not miss future lessons. Also, drop a comment below. Which journal entry example was most helpful to you? Or tell me which transaction still confuses you. Until next time, remember, do not guess the debit or credit. Identify the accounts, understand the story, and let the rules guide you. See you in the next class.